We Australians have an obsession with trusts. There are way more trusts than companies in Australia. In fact, according to the tax office, there are around 970,000 companies in the 2017 income year, compared to almost 1.4 million trusts and superfunds. There are real estate investment trusts, managed funds, managed investment trusts, testamentary trusts, public unit trusts, and even self-managed superfunds are also trusts. Rich folks particularly love discretionary trusts, also known as family trusts. And this is what we'll be focusing on today. The 5 reasons why Aussies love trusts, specifically family trusts. But before we get into that, a bit of background on trusts. So what exactly is it? A trust is basically this relationship between the person looking after the trust and the person benefiting from the trust. That is, a relationship between the trustee and the beneficiary. For a trust to exist, there must be trust property or assets, like there has to be something for the trustee to look after. That could be cash or real estate or shares. The rules on how the trustee should look after those assets are usually contained within a trust deed. An example of a clause in a trust deed might look like this. The trustee should only ever distribute the income to certain beneficiaries, like my family members. Discretionary trusts are particularly unique because it's up to the trustee to decide who should get the distributions of income generated from the trust assets each year. That is, it's subject to the trustee's discretion, hence the term discretionary trust. Trustees are appointed by an appointor, who is usually the ultimate controller of the trust. Like, if you were going to set up a trust for yourself and your family members as beneficiaries, you would make yourself the appointor and appoint someone you trust as the trustee. But if things go wrong, you can always fire that trustee and appoint a new trustee. According to the tax office, the discretionary trust is the most common type of trust found in Australia by a long mile. And here are the reasons why. Reason number 1, privacy. The legal owner of a trust is the trustee, who is merely looking after the trust for the benefit of the beneficiaries. Nobody actually knows who actually owns the trust beneficially, or who really controls the trust, which is great when you don't want people sticking their noses in your business. It's also very common for the trustee to be a company, and for some beneficiaries to be the directors of the trustee company, rather than the beneficiaries being trustees themselves. This makes it a lot harder to trace through who's actually in control of the trust. Number 2, asset protection. Rich folks put their assets in a trust rather than holding them in their own name. Like, they would put money in a bank account, but it's under the trust's name. The legal owner would show up as the trustee rather than the person's own name. Say a rich folk's daughter meets a pretty boy / gold digger who is really after her family money. The money is locked up in the trust. When she inherits the trust, like becoming one of the directors of the corporate trustee, nothing's in her own name. She merely gets distributions from the trust as a beneficiary. And pretty boy will not be able to access the money in the trust if they have a relationship breakdown. This is no laughing matter. I have seen so many trusts which only allow beneficiaries that are blood related. Have you seen the TV series Dirty John, where Eric Bana plays the gold digger? It's based on a true story. Check it out. Anyway, I digress. Apart from gold diggers, the trusts can also protect family assets from other potential threats such as bankruptcy and malpractice. It's like this firewall that insulates the assets from potential lawsuits and creditors. Number 3, less compliance. Companies have to report to ASIC, and there's also a requirement to lodge annual reports each year, not to mention independently audited financial statements if the company reaches a certain size. There are no such requirements for trusts to report to ASIC or to be independently audited, regardless of their size. Number 4, flexibility, or what I like to call ruling from the grave. The discretionary trust is probably the most flexible structure available in Australia. It provides this ability to choose who the distributions can go to and what amounts they should get. And this can vary from year to year. Capital or revenue can be distributed to different persons, and this can also change from year to year. Because of this flexibility, rich folks use trusts for succession planning. Say you're a very rich dude and you're getting old and you've got 5 grandkids and they're all in their 30s, unmarried, they have no kids, and you're really starting to get worried about the end of your lineage. So you set up a trust and put all your assets in there. And in the trust deed, which are the rules of the trust, you say that grandkids can only become beneficiaries of the trust when they get married and have their own kids. Yes, discretionary trusts would actually allow you to do that. That's a pretty extreme example, but think of other things that can be achieved, such as using trusts to ensure disabled family members are looked after when you're not around. Number 5, I've saved the best for last, which is tax planning, aka legally avoiding tax. A trust can distribute to the most tax advantaged beneficiary every year. Say mom and dad sets up a trust, which holds their share portfolio and it earns dividends each year. Mom has a full-time job and dad decided to stay home to look after the kids because of COVID, and so he has no income. The trust can distribute its income to dad rather than to mom because he would be on a lower marginal tax rate than mom and so he pays less tax. So together they'd be paying less tax than if any of the distributions went to mom. This is a very common trust strategy known as income splitting, and the Labour government really does not like it at all. They promised to crack down on trusts if they won the last election by introducing a minimum 30% tax rate for all distributions from discretionary trusts. Trusts can also access the 50% CGT discount, unlike companies, which means that CGT on assets sold, which have been held for more than a year, is effectively halved. A discretionary trust can stream capital gains and franking credits. For example, Mum and Dad's trust sold shares during the year and it made a very nice capital gain. The trustee can choose to distribute all its revenue, i.e., the dividends, to Dad and all of the capital gains to Mum. It so happens that Mum has made some capital losses in the prior years during the GFC. So the capital gains can be completely absorbed by capital losses and she pays no CGT. So there you have it, 5 reasons why we love trusts. It gives us privacy, it protects us from gold diggers and potential lawsuits. There's less red tape, it's so flexible it allows us to rule from the grave, and to top it all off, it saves us tax dollars. I'm thinking of making a series of explainer videos on trusts, and maybe covering things like trust loss testing and family trust elections, whether there can ever be a fixed trust after the colonial first state case. The list is endless. Let me know which area you find particularly confusing and you'd like to understand better. Drop me a comment below. Anyway, I hope you found this little text nugget interesting. Thanks so much for watching. Until next week. Bye.